All right, good afternoon. Happy Friday, everyone. Welcome back to Wook Capital Management's weekly Wook and Review broadcast. We're going to be reviewing our 16th newsletter out this morning. For those of you following along live, check the pinned nest in the spaces. If you're catching this replay on YouTube, of course, you're good to go with your screen. And we'll spend about 40 minutes walking through our prepared material, talking about a couple of different topics this week. We have a continuation with regard to PLBY, although we talked about them last Friday regarding their amended rights offering. There were several press releases in the ensuing days, so I think we'll need to touch on those, have an assessment. I'll share with regard to my personal account, how I've opted to play that. And then we are going to talk a little bit about Tesla. There's been some debate over what their price cuts that they took late last week mean. We didn't really talk through it much last week. We did talk through falling asset prices, both automotive and home related. So we'll talk about those two topics, and then we have a couple of other highlights to share. So, excuse me. With that underway, again, I'm Rod Altman. I'm Wook Capital Management's managing director. I just need to ensure that everyone is aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from their professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. And of course, past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So, with my mouthful of a disclaimer out of the way, let me get right into it. So, there's been more news this week. We talked about it late last year, and we mentioned that after I forget which Wook and Review it was, but it was after the midterm election results had gotten more finalized, that with the tightness on the House side, and we've seen it play out with the longest batch of votes to elect the House Speaker since before the Civil War, if I have my dates right. There doesn't appear to be, you basically have a minority leading the House with, some extremists that might be happy to hold up a debt ceiling agreement. Clearly, it's still early. The debt ceiling hasn't been breached yet. As the graphic, I think Bloomberg had an excellent graphic, and I linked the story. Joe, if you can maybe pin or that one. I know you have the thread pinned, but it's in the thread. But the graphic kind of showing that as the Treasury continues to not be able to surpass the current debt limit, they've taken quote unquote extraordinary measures to overcome that challenge. They basically have until the third quarter before all of these extraordinary measures, which Secretary Yellen at the Treasury, these quote unquote extraordinary measures are not completely new. It's happened before. It will probably happen again. I think that the concern with this year's iteration of the debt ceiling fight is that you have a very small Republican majority in the House, and you have a very vocal minority group that may hold things hostage. It doesn't seem like there's much of a willingness on the Democratic side to meet the Republicans where they want. So, as with all things politics, things can change very quickly. It's something you probably don't need to be hyper obsessed with, but it should be on your radar that more so than in years past, think back to 2011 when there actually was the downgrade of the U.S. credit rating due to the standoff over the debt limit, 12 years ago. this year does seem to most prognosticators to be the closest to an echo of that, and it remains to be seen again what will happen. Um, but coming later this year, Treasury will run out of space with those extraordinary measures, and if action isn't taken, um, as Wall Street Journal reports, quote, a loss of investor faith in the U.S. to pay its debts could spur a deep sell-off in Treasuries, which could in turn cause chaos in financial markets, lift interest rates, and raise borrowing costs in U.S. debt. Um, I don't want to prognosticate too much about it. I had read some reporting that the House Republicans were working to structure this in a way that folks who receive payments from the U.S. government, like Social Security beneficiaries, some others, would still receive payment, or at least a prioritized payment, even if there were a default. So it's still unclear again how exactly this will pan out, but it does seem like the risk is more elevated than in most years past. And it is a very silly accounting thing. It's these payments have already been authorized by Congress. In this case, preceding Congresses authorized these payments. The fact that there's this arbitrary limit to allow debt issuances, even for spending that's already been authorized, is kind of just one of those political footballs that tend to get kicked around from time to time. There's no need for there to be this limit. There's a couple of quirky little ways, if you've read or heard about, like the idea of Treasury minting this platinum coin. But again, we'll not spend much more time on it in subsequent Woken reviews until we get later in the year when it's maybe more clear what, if any, negative impacts there are on U.S. creditworthiness. But it does look like sometime in the third quarter, the Treasury will run out of cash and exceed the debt limit, and we'll see what happens. But that you'll see those headlines in the news, I'm sure, in the coming months. All right, this story I found very interesting. It's a sector that was one of your high growth, and this is another one of those sectors that I think of as potentially just a pure byproduct of the ultra accommodative zero interest rate policy post global financial crisis. The meatless meat players like Beyond and Impossible, and what somebody shared in the Wook Discord that one of these companies in Canada actually went into receivership. The company's called Very Good Foods, so they weren't doing very good apparently. Meatless meat's market share is down meaningfully in 2022. Supermarket sales down 14% year over year of meatless food per Nielsen data. Food service orders per NPD group down 9%. So I think the question around this meatless food is obviously there's a mix of the population that's vegetarian and vegan who are interested in these products, but for the omnivores that constitute the bulk of the population, there were some impressive scientific breakthroughs with these kind of new meatless meats, with the trying to recreate the mouthfeel and the taste of it. For Impossible and Beyond, I included a link, and it was the big take in this week's Business Week. The story came out yesterday morning. It's worth a read. It's a pretty thorough article. I don't want to rehash the whole thing, but certainly anyone who wants to chime in on their thinking around, whether it's Beyond Meat or as an investment. The stock for Beyond is it IPO'd in 2019 at about $67 a share. It's trading at $15 a share right now, so it's down about 77% all time. And it still has about $1 billion market cap. And I don't think they've ever been profitable. It's another one of those, it seems like a lot of capital went into the space. You had Impossible is still private, and I believe it mentions in the article that in the private markets, they're trading down about 50% from their latest capital raise. So, and this got really hyped over the preceding decade. The story talks about investments from Bill Gates, talks about them being able to raise for Impossible at least $183 million before they'd even sold a single burger. And now seeing these declines in sales at both the supermarket and also at restaurants begs the question, in the cover, was it just a fad? Is it just a fad? There's clearly going to be these vegetarian meat options. There are competitors that have been around for many years, but are these new players truly taking share like they predicted? For example, the story notes that in 2019, the New Yorker profiled Impossible, and the founder, quote, predicted his company would, quote, take a double-digit portion of the beef market by 2024, so in 5 years, before sending it into a death spiral. Maybe it's going to be a death spiral for these companies if they can't get access to incremental capital at this rate or change the trajectory. So I just think it's interesting how quickly things can shift from being the shiny object in the room to oh, that's last year's fad. Again, I think I've had one of theirs. I don't know if it's Impossible or Beyond. I mean, the story again kind of talks about the fact that when you look at the nutritional facts, and it cites one individual as an example of where they were having health issues and went to their doctor, and the doctor points out, this is processed food that you're consuming. You look at the nutritional information, there's not a meaningful, benefit other than that it's not meat, not from butchering a cow, which begs other ethical questions, of course, depending on your worldview. There's obviously resource considerations. It takes a lot more resources to produce cows and chickens and pigs than it does to produce vegetable proteins and bugs. Not that this is talking about bugs, but it just doesn't look like right now consumers are really picking up on it. The quote from one industry analyst was that the all-important meat eaters do partake, but at a much lower frequency. They're just not that into it. So that's what's going on with Meatless Meat. I think it's worth checking out the story. It's a pretty thorough, well-written story. Okay, we got one more highlight before talking about the two main topics, and then I happily will open the floor up for any comments, questions, dialogue. So freight markets, we've talked about freight markets in several other Wook in reviews. It's an industry I know fairly well and worked in for several years before joining Wook. It's a good harbinger. You can have freight recessions without macroeconomic recessions. There's actually more often are there freight recessions than there are entire economy recessions. The freight market, the trucking market in particular, had been very challenged in terms of the rates that truckers were able to charge because, as we've kind of talked about, there was a big bullwhip effect going on where, in 2020, first you shut things down, then you shoveled money into consumers' pockets, and they weren't really able to spend on services. They spent a lot more on goods. So retailers and the like began ordering a lot more goods. Freight rates, both ocean shipping and over the road and rail, et cetera, went very high due to the huge uptick in demand and some constraints in supply. And for much of 22, those prices were trending downward. The graphic I have up here, this is FreightWave's National Truckload Index. So you think about a long haul trucking lane. Granted, every lane is different, every market's different, but the average in the US rate per mile as a most recent data point was right around $2. And you look at that, it's still elevated. It's recovered somewhat. So you've got prognosticators asserting the bottom might be in, at least the local bottom might be in for freight. JB Hunt is a major transportation. They provide intermodal services where it's a trailer that is moved by rail and then a truck takes it from the rail yard to the fulfillment center, distribution center, et cetera. So they have a pretty broad transportation network that they participate in and see. And the quote from their president in the analyst call on Wednesday was we have had good signals from our customers about Q2 having a more normal environment. We're not sure at what point that is in 2Q. We have confidence from what our customers are giving us and the data points that they have about what they're going to be doing from an ordering perspective. So she said JB Hunt is feeling the impact from import declines, but noted its customers have indicated the diminished volumes are tied to what will likely be a near-term inventory correction. So that builds on a lot of weakness in freight in the peak fourth quarter season. So Hunt indicating that they're getting signals from their customers that by the second quarter, they should have pulled out of this trough. That's obviously positive for the industry. You have Craig Fuller, who is the head of FreightWaves, and he had been tweeting. I didn't include the link, but he had been discussing, and let me see if I can find it. Joe, maybe you can find it. Freight Alley, at Freight Alley is Craig's handle, and he had tweeted earlier this week about what he was hearing and seeing. Yeah, his comment on the 18th, BOA turns bullish on the truckload sector based on their shipper survey report. Coincidentally, our tender data, and BOA's shipper survey data has shared similar sentiment over the past year. So FreightWaves, way back in March of 22, kind of called for the impending decline in the freight market, which happened. Freight rates declined. Again, as we always kind of talk about here, just because the real economy, just because what's happening in freight is bad or is good, doesn't necessarily mean that the stock prices are moving one for one with what's happening in real time in the economy. So take that as you will. But it does look like freight kind of sees at least a local bottom and sees some brighter days coming into the first half of 2023. So that's good. Although, as we talked about last week and have talked at length, a lot of the manufacturing data and also the services PMI data show ongoing deceleration in the economy, some contraction in manufacturing based on the ISM PMI. So, we'll continue to monitor those as we try to get a handle on, where is the economy going. Okay, last two, we've got Playboy with the PR puke. So last week we talked about the amendment to their rights offering that came out on January 9th. So on December 19th, recall that the company had announced a rights offering. They were seeking to sell shares of the common stock at $3.50. The CEO and other executives dumped hundreds of thousands of shares in the days preceding that, and unfortunately for shareholders, sent the price to all-time lows. They then came out this past Monday with the amendment where the rights offering would now be that 350 and 85% of the volume weighted average price through end of business today. I know someone in one of the Playboy servers that I participated in noted the volume weighted average price over those 10 days, at least through early afternoon, was coming in such that a 15% discount to that VWAP was about $2.55. And the way that this amendment worked, you would basically have gotten 0.306 yada yada shares of stock per right, or the right to purchase that many. And then if it ended up being the lesser, you basically get more shares at that lower price. So since the subscription price will be $2.55, the discount will be around $2.55, give or take, then the excess amount paid by holders will be applied to those purchases. It was very strange. Just again, from a timing perspective, you had that amendment, then 3 days later, you had them come out with this joint venture for Playboy Spirits with a private placement of senior secured convertible notes with very little detail. And then you had on the 17th, earlier this week, you had them come out with what management had alluded to a China joint venture in the preceding quarter in the earnings call with very little detail. They came out with this press release that also has very little detail. It's simply that they are partnering to, they've come to an agreement to form a joint venture to be called Playboy China, which will own and operate Playboy branded consumer products business in parts of the China market, including mainland China. And this partnership, this joint venture, excuse me, with Charactopia, which is Li and Feng's brand management company. The only detail that we get is that Playboy would retain majority ownership, which in all likelihood means 51% or 50.1%, and that the partners value it at $250 million. Now, what are the economics of this JV look like? How does this change their existing licensing agreements in China? There's some quotes from the Playboy CEO Ben Cohn and from the executive director of Feng Retailing in here. There's just not a lot of information. The only thing is they expect to begin to complete this JV and begin operations of this JV sometime in the first quarter. So, okay, that came out while this amended rights offering was going on. The next day, again, you had this PR puke. It smelled like desperation. When you look at it in the big picture context, it just doesn't add up, right? Management had raised $50 million in May under the auspices that it was for share buybacks of sale of preferred stock. So management has done such a poor job with capital allocation over the last 12 months. It did not seem like they were getting much, uptick of participation in this rights agreement, even with the amended terms and even with them shoveling PR after PR out the door with very little detail, that they then secured a $25 million capital commitment from a private equity friend of Cohn's, Michael Soroya. I don't know how to pronounce his name. I say friend only because I spoke to another investor who indicated they have a relationship. I don't know the details of that relationship. Basically backstopping the rights offering with some very favorable terms, including over $1 million commitment fee. So the company, again, paying a $1.25 million commitment fee to secure the backstop of financing. So a lot more questions than answers, to be quite honest, is how I interpreted all of this action. In at least my personal account, as I communicated on my personal Twitter account at Rod Alsman, I've opted to fully exit any call spread positions that I had in Playboy. I did opt to subscribe to the rights offering because mathematically it kind of worked out like this, right? As I said, you could acquire the shares at roughly that $2.55 per share. Shares closed trading today at $3.69. Nice. So you could, assuming you were able to short shares, because you're not going to get the shares for about, I was told, 14 to 15 days by TD Ameritrade. So you're buying the shares, but you obviously are bearing risk of the price declining in the interim period. Those shares you bought for $2.55. So you could have shorted shares in advance of receiving the shares, at say $3.70 today, and then that would be offset by the shares that you bought at $2.55. You could have hedged through call writing or potentially through purchasing some puts. I hedged all of my personal shares through writing $2.50 calls against them. I also did begin to accumulate some put options for July expiration at the $5 strike. So I'm pretty bearish around all of this activity. It looks like desperation. I follow very closely what's been going on. They've been sending out a lot of emails about new products, and unfortunately, their sales rates have not ticked up meaningfully, which tells me there's going to be a significant build in inventory in the fourth quarter, and it's unclear to me where they stand. I've also made it pretty clear that faith in management is not something I have, and regrettably, with how the governance is structured at this company, there's really no means to dislodge management, given the largest shareholder is also the chairman of the board, who also has an investor rights agreement that effectively prevents there from being any attempts to conduct activism in the company. So a lot of news happened. I felt the need to update folks and make them aware. I see there's obviously several folks listening, some bull, some bear, that I can see just by their profiles. I'd welcome them to share their thinking once I get done going over Tesla, which is always spicy. We always love talking about Tesla. You never get enough. It's just Elon wins, right? He's always in our minds. But unfortunately for him, he had to take action to significantly cut price over last week. Now I've seen I've seen Tesla bulls trying to prognosticate that this is 4D chess. So Electric, it is a publication that I think does actually a fairly good job of not just being Elon stands. I think that Fred Lampert for many years has covered Tesla, and while of course he's supports their mission and is a Tesla bull, I think that his reporting has been pretty unbiased, relatively speaking. But his headline out with his article out today, Tesla just started an EV price war that it will likely win. So there's the short-term consideration, right? Tesla cutting prices by many thousands of dollars. What does that do from an income statement perspective? Well, those thousands of dollars of cut price are purely thousands of dollars per vehicle of margin that is lost. So at least in the short run, right, it will, all else equal, negatively impact their margin percentages, will negatively impact their margin, well, depending on what the impact is on net sales, there could be a negative impact to gross margin dollars as well as the percent. We know the percent will go down. Dollars, it's a little hard to play the what if game in lieu of the cuts, but it's an indicator that they're dealing with demand challenges, right? So they cut prices, not just stateside, because obviously stateside, as we've talked about, there's a lot of, with how the Inflation Reduction Act has restructured the tax credits, there's a lot of, basically automakers playing around with price. There's now, separate from the Tesla conversation, this decision by Treasury to basically there's a kind of this commercial vehicle loophole. So leased vehicles will basically be able to take the credit, even if they don't otherwise satisfy the intentions of the IRA, which was that the batteries needed to have the supply chain being located domestically. So anyway, a lot going on beyond just Tesla. But right, they cut the price by 20%. Some vehicles were talking up to $21,000. And then that's where you get this conversation. Is this in fact a genius 4D chess play where, because Tesla has slashed prices, the view being that, well, this also harms their incumbent and other startup EV, their incumbent OEM and other startup EV competitors, because now Tesla, the bulls prognosticate that Teslas are so much better than the other vehicle options in the market that this will just serve to degrade from other automakers' margins. Electric's reporting notes that they're seeing other automakers following in the price drop. For example, XPeng saw its sales drop during the week following Tesla's price drop, and the company has now implemented important price drops too. So, in a price war like this for Tesla, there's a nice graphic here that was, it looks like reported in Reuters yesterday, showing net profit per vehicle. So of course, Tesla has shown meaningful gross profit and has been the most profitable on a per vehicle gross profit basis. So the thinking here being that because Tesla can afford to give up some of these profits in the short run, if it were successful in negatively impacting competitors more, perhaps in the long run, there will be less competition for Tesla, and therefore they'll grow out of these margin cuts. I don't really buy that personally. it smells a lot more to me like demand is being severely challenged given the massive hikes in both rates and the kind of exhaustion of the consumer being able to support some of these extraordinarily elevated payments. You know, I forget, Joe, if it was in our weekly open mic last week or if it was in our last Wook review, but we kind of walked through the example of, you know, a lay person buying a Honda Civic versus a Tesla Model 3 and trying to get the math to square for the TCO making sense for the Tesla Model 3. And, you know, and it really didn't in most cases. But the thing that's so important in EV is it's always, 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 at least for now, driven by what's going on in the incentives market. So I have an article that was out that caught my attention on the screen. It's about heavy duty electric truck subscriptions. So this was earlier this week, a story talking about, you know, in the LA and in Long Beach ports, you've obviously got major incentives from the air quality management districts, from California Air Resources Board. There's these hybrid vehicle incentive programs. There's these other programs. I'm sure most people recall the major reporting about the Tesla Semi deployments at the Modesto Frito-Lay facility. Well, that Modesto Frito-Lay facility was the recipient of, you know, tens of plus millions worth of incentives for the state to electrify, and it wasn't just deploying Tesla vehicles at that facility that, of course, Pepsi finally took possession of late last year. So this is specific to drayage, which would be, think your truck that puts a container on the back, that takes it from the port and then drops it at a distribution center somewhere in, you know, the Inland Empire in Ontario, whatever part of, you know, SoCal, before maybe that container gets loaded on another truck to take the long drive across Interstate 10 to Dallas or Atlanta or wherever. It of course could get loaded and kind of do like a transloading thing where the drayage truck, you know, takes it from the port to a rail node, and then we talked about JB Hunt earlier, where that container then gets put on a train, which then takes it most of the way, and then from that next rail node, another drayage truck takes the container to the distribution center or fulfillment center or wherever, right? So, you know, this is all supply chain movement, but in Southern California, the geography is such, as many I'm sure know, that the air quality, just because of it being kind of this basin, you have all these trucks running diesel engines. There is a lot of negative. It's not just carbon dioxide; it's the nitric oxide and nitrogen oxide and the particulate matter. That's the really nasty stuff that, you know, unfortunately causes things like asthma and other issues. So, you know, there's obviously a public health reason for the state and for these localities to invest significant sums. But then that's where I get back to, you know, on a standalone basis, it's really hard to make the math work. So the reporting talks about, if I can get to the part of this reporting, that, you know, then there's the price tag. Quote, diesel drayage trucks can cost $100,000 to $200,000. Electric versions retail for more than twice that. Think about that for a second. And this diesel, first off, most of the drayage trucks, these trucks are doing a couple of turns a day. You know, they're going to get a load, drive to the distribution center or the rail node or whatever. They're going to turn around, go right back, get in line. You know, they're going to try to turn around 2 or 3 times in a day. These are not long haul trucks. When you think about the type of vehicle that's being used for drayage, it's an old tractor. It's a piece of equipment that somebody like JB Hunt or Knight Swift, you know, your big truckload operators are going to operate new equipment over the road in scenarios where they can't afford downtime, where the engines are covered by warranty, and where the only service in the first 3.5 or so years of the truck's life is really going to be your preventive maintenance, your oil change, and the like. After it gets out of warranty, you know, that truck might get sold to a smaller fleet operator who then maybe operates it for a few years, and then it gets sold to, you know, a drayage guy who's going to have this 8, 9, 10+ year old truck that costs, you know, tens of thousands of dollars at that point in its life used. And yes, the operating costs are higher because it's less fuel efficient, it has more downtime from breakdowns, but it's less of an issue because it's not doing over the road. So just from like that's kind of how the life of a truck works a little bit. So people that are operating drayage fleets typically aren't going out and buying the brand new Freightliner for 150 whatever $1,000. They're usually buying a used piece of equipment for what used to be 30, 40,000, which today is now maybe almost double that because of the continued inflation in used vehicle prices. That is still moderating, and that will continue to moderate over the course of this year. If you want to follow that, you would want to follow Ryder. When Ryder reports, they break out used vehicle results, and they're the most detailed of any of the public companies. The other one you'd look at would be Rush. Rush Enterprises is the only big public commercial truck dealership, so they also have some commentary on used truck prices. But anyway, my point really being that if it's going to cost you 300,000 plus to buy this new drayage tractor, to get that payback to pencil out, with that let's call it $150,000 capex premium, you're of course now going to have to see an opex save, inclusive of the time value of money, that's nominally greater than that 150,000. So that's not going to pencil today. It's where these incentives come in that can make it pencil today, because you have CARB offering $150,000 to offset the cost of the electric drayage truck. Well, that slashes most of your upfront premium. And then the Inflation Reduction Act now has a cap at 40,000. So you now have state plus local plus federal benefits that can make sense in some cases, right? To the extent you're able to tap these incentive programs to buy the electric vehicle. We ignored altogether the fact that there would need to be make-ready infrastructure upgrades at whatever domicile that truck is going to stay at overnight. So, it's still obviously, look, I get it from a public health, public policy. California likes to do what it likes to do, but just economically, at large scale, those numbers don't square. And while you could do targeted incentive programs to try and clean up air quality in a certain part of California, it still doesn't pass the test of being at or better total cost of ownership in an unsubsidized capacity for almost all applications. And the only ones that can really start to pencil out is think about your Rivian trucks that Amazon's beginning to deploy, your UPS and FedEx. Again, we've talked about this. This is where you have equipment that it doesn't weigh out, it cubes out. You fill up the inside of the truck with packaging before you've hit your weight load. You're doing a lot of local stop-start driving as opposed to an over-the-road haul. I had tweeted, I think it was within the last week, a little bit about like hydrogen internal combustion engine, which is a novel idea, because again, it goes back to the whole conversation with electric trucks and electric vehicles in general, where you don't have the same service networks today that you have on the internal combustion side. So if you swap out a diesel engine for a hydrogen engine, for example, you keep all of the other componentry consistent on the equipment, the retraining cost and the investment to kind of make your technicians able to handle that equipment is a lot less. So like there's all these different considerations. Again, I get really hyped up on this because I spent many years in corporate strategy at Ryder thinking about this stuff, and you see so many headlines about it, and a lot of the time the discussion is lacking and doesn't really consider a lot of angles that a fleet has to. So I know that went a little bit away from Tesla. Obviously, Tesla has the Semi. We still don't know much about it other than that Pepsi has a few of them. But I'll pause there. It's 4:43, so spent about 40 minutes, about what I thought I would, going through the prepared content in this week's Wook and Review. Joe, appreciate you pinning things as I went all over the place. Yeah, I would welcome if anyone wants to come up and talk. I know Jimmy, you're a Playboy bull still, and if you want to kind of talk about how you're seeing things, net of the rights offering and the PRs this week, would love to welcome your thoughts. I had seen I had seen Mr. Vaxxed, Triple Masked in there. I don't know if he's going to chime in. He's been posting some bearish things for some time about PLBY. If he wants to share his thoughts, he's welcome too. But Joe, I'll pause. Any questions for me before anybody raises their hand, or you pick on them and try to drag them up?
Yeah, I'm inviting up some speakers, some of the usual crowd, but let's see. I mean, personally, relating back to the Tesla stuff, I mean, I have friends who recently bought a Tesla and used Tesla, and now, the new version of the same car would have cost them less. So that definitely stings. But
What is their
I guess,
reaction? Like, is it I'm mad at Elon, I'm not going to buy one again, or just oh this
well, I've
sucks?
seen the reaction is to go try and sell it on Facebook for what they have into it, and then they get left with the haha react on Facebook, and then comments telling them that it's not worth it anymore. So that's definitely feeling a little burned. I don't know if they feel burned by Elon or just by the trajectory of the car market, but yeah, can't imagine it feels good.
I I know I've seen different people posting about the your Carvanas and your CarMaxes of the world all effectively having to slash price on the used equipment because they needed to move it. When you're an auto dealership, these are not appreciating assets, despite what Elon liked to claim. These are depreciating assets that your goal is to move as quickly as possible. So I know I saw different people on Twitter and elsewhere talking about how basically right after this happened, you had huge cuts to price at your dealerships to try and move that equipment. Yeah, for anybody who still has one, being upset that the price went down. If you actually needed to get out of the vehicle, you need to move with the market. The market has lowered the price. But that was one. I mean, Teslas for a long time had been uh, held up in terms of residual value very well. So to their credit, but obviously when you slice new vehicle prices, that's going to slice used vehicle prices. And hey, David,
How are you doing, Rod? And how are you doing, Joe?
pretty good.
I think Tesla, just to continue on that conversation, sorry to just interject here, Rod, Joe, thank you for the invite as well. I think that like when we consider and aggregate the holdings and retail participation within Tesla stock, more than 43% of retail participators are holding it in independent stock accounts. And then when we aggregate the actual residual 25% of passive flows, it's actually, again, the same retailers that are participating it just in 401ks, pension funds, and other formal insurance funds. And so essentially, there's roughly 65 to 62% of all outstanding stock held by emotional retailers.
It's a good point, David. It's very heavily retail owned, and it's not a one for one comparison. Last night we talked about the Netflix call and what happened to the share price for Netflix once the story went from growth to, well, maybe it's not growing at the rate it was, and it's maybe more value, and how share price was obviously off a cliff when certain investors who were growth oriented in nature decided to exit. Mr. Ackman, most, I guess, prime example of that. But with Tesla, right, they've kind of talked about their aspiration for that 50% sales growth. I am looking at analyst estimates through Coifin data that show, at least as of, let me look at annual, excuse me, and not quarterly, but at least as of right now for full year 23, sales, you're talking 30%. Then for full year 24, 28. And then for full year 25, 17. Now, of course, those are estimates. And I know now Tesla bulls are talking up the mega pack opportunity and the like, but when you're paying such a high price for something, if it is in fact growing at those rates, then you could get a good return, right? But I think that's where the concern I would take away from these price cuts and clearly diminishing demand for premium priced autos in a slowing economy, or at least my perception is a slowing consumer economy. It will be difficult for them to reach the goals they touted. And then when those goals are missed, or the reality is less than what the expectations have been baked into the stock, the only response is disappointment. I mean, it was really hard to see how when it was valued over $1 trillion, how disappointment would be anything but the outcome. I, for a long time, have been of the view that Tesla is a lot like Cisco in that the price got so far ahead of the underlying business. It's not that Cisco was a bad business, but of course, it took a long time. And depending on when you bought, you may have never gotten back to par on your money. I'm not saying Tesla will get back to those levels, but just that it feels a lot to me at least like there's a corollary there. And you make a great point that retail ownership is extraordinarily high in this stock. It really is the OG meme stock. I
Well,
think it's
one was brilliant in that sense, right? Because outside of like potential scientific and technological evolution Tesla can integrate, he really utilized the stock as an advertising and or a method to capitalize Tesla.
absolutely Elon Musk, hands down, one of the greatest promoters of all time. I think people, even people who don't aren't big fans of him, I think it's hard to argue that he's been incredibly effective at promising a lot and getting people to buy into those promises. And
Exactly. If we look back in 2020, when we went into Tesla Day, I think, and before the S&P allocation, he had announced like a new revolutionary battery technology, and that he would be using cobalt and other formal graphite uses. But when we look at the base development, especially with the mega pack, it's just a standardized lithium iron phosphate battery. And longevity wise, they stand to hold a lot better than lithium ion, what we see as battery cells within the car. But in a short, unless really decides to say, I'm going to revolutionize how we decide to pack and layer our batteries, then the residual metals still stand to profit more, like graphite, lithium, cobalt, copper, all of these base metals that are required in order to make a good battery cell are going to just uptick in demand. Specifically, if we look at graphite, in the presupposed demand chain line for the next 5 to 10 years, there's over 1,967 tons of required graphite to be developed. In reality, we only produce roughly 900,000 tons. All of the graphite we produce is fairly residual, but there's a 3x demand increase just in the last 2 to 5 years. So it's going to be very interesting for your residual base metals.
Yep. Good points. I saw yesterday in Bloomberg Hyperdrive newsletter, which I recommend as a subscription as one of the daily newsletters you get uh, if you don't get it already. I saw that they have been tallying Bloomberg's new energy finance team, BNEF, has tracked 28 billion in new electric mobility related investment announcements in North America since the Inflation Reduction Act passed in August. Now, it's not those aren't investments to what David was talking about in mining capacity, but those are investments kind of throughout the supply chain, whether it's battery, pack, and module kind of assembly or manufacture. Of course, those raw commodities have to flow into the cells, which are then sorted into modules, into a pack, and then assembled into a full vehicle. That's what the Inflation Reduction Act intended to do, was to localize a lot more of that investment into North America, and so far it seems like it's succeeding. And there's been a lot of reporting in that I've been following about a lot of the German OEs and others kind of reconsidering their investments in Europe. And here, Sweden's Northvolt is considering delaying plans for a major cell factory in Germany and instead expanding first to North America. So now it's not one for one with what you were talking about, David, with the raw commodities. But yeah, clearly there's a huge uptick in demand for your nickel, your graphite, I guess depending on the chemistry, cobalt, and will we be able to satisfy building all these cars, right? So there's a lot of question marks out there still.
Theoretically, if we go by the proposed in the EV bill. No, we do not have the substantial materials and or the production and reserves for the next, I would say, till 2023 to undergo a 23 million cars on the road by that time, specifically in your base metals like copper and cobalt, right? Lithium as well. So it's going to be very interesting unless we have like this actual technological evolution within battery technologies and how they're holding and storing their energy in that sense. We won't be able to actually support the actual materials. Interesting. Graphite, on the other hand, is an abundant material, but still stands to profit because in any compositions of a battery, graphite is always going to be the inert material used in order to be that electron maintain. I'm not going to go too in depth inside battery maintenance and development.
Yeah, I'll pull up a visual. You likely know this, but for folks who hadn't heard me mention it before, the BNEF does this battery cost curve survey every year, and the last one came out in December. And what they found was that lithium-ion battery pack prices rose for the first time, basically since they started tracking the market in 2010. I mean, this if there was one curve that explains the why for the rapid uptick in EV proliferation, it's this one. It's seeing battery pack costs go from, they don't show 2010, but I know it was over $1,000 per kilowatt hour in 2010. The curve fell every year until 22, where the commodities you're talking about, like lithium, nickel, cobalt, rose massively in price. And even though they continue to get the benefits of both scale economies, of process learnings, continue to improve the efficiency by which they operate these manufacturing and supply chain processes, that the net change was pack price went on average from 141 in 2021 to 151 in 2022 and aren't expected to start dropping again until 2024 because those commodity prices are so elevated. Your cathode, which is where the lithium, the nickel, the cobalt is part of the cathode chemistry, and that's more than half the cost of the battery pack. So unless something changes meaningfully in the short term, those mines don't get flipped online overnight. It's going to, I think, and it's unfortunate for the EV prognosticators if things stall out near these levels and we don't see a resumption of the cost curve declines, because a lot of the estimates I saw were the adoption estimates were predicated on really continued decline in the cost of these battery packs. And you made a point about, will there be, I think you said solid state, right? That's kind of the holy grail if it can get to the solid state commercialization. And things will certainly change if and when that happens. But for now, it's just a question of the math. And as I kind of pointed out with the heavy duty trucking example, for now, those packs just still cost way too much in many cases for there to be a TCO, total cost of ownership, argument to be made. And if you're talking about commercial fleets of any kind, total cost of ownership is what they tend to care about. And I know in my time, again, at Ryder, in all of my work with consultancies, experts in the industry, OEs, it was basically until you get to TCO, you won't even see an uptick in adoption. You need to see superiority in TCO, and only then can you really start to see a meaningful uptick in adoption. And obviously, I have made it clear that in my personal account, Allison Transmission is one of my largest holdings because I have that view that Allison Transmission's commercial truck transmission product is not going to be disintermediated as quickly as maybe the market implies at their current valuation. But it's always an interesting conversation. I love talking about it. And yeah, David, you can go in the weeds on stuff if you want. But certainly, if there's anyone else, if you want to talk more about EV, Tesla, other, please feel free to raise your hand or come on up. It's almost 5 o'clock. It's Friday. I don't want to be on here all day. So I figure we'll, depending on how the conversation goes, run another 30 minutes, maybe 45 minutes. If we get some good conversation, maybe let it run till 6. Otherwise, if there's not a lot to be said incrementally, then maybe we wrap it up a little sooner than that. But Yeah, David, I don't know if you had any thinking on what I was just saying about like the pack prices from what you've been seeing.
So, if we go on the assumptions that the base materials on the long term are going to go up in price, I think that's observed specifically as well. Like the biggest automakers in the world right now are South Korea and Japan. And when we look at metals and or pure metals, I should sorry, precious metals that are in demand, they're rhodium, palladium, and platinum. They're conducive to to having this relationship with other base metals such as copper, nickel, and zinc that are also used within the automaker type manufacturers. What's really interesting is most of these base metals are trans-relational between your ICE vehicles and your EV vehicles. And so unless we have adequate like supplies on either base materials, there's going to be a disjunction and or obviously increased demand on one end or the other. And so definitely when we're at the potentialities, personally, Japan is looking extremely interesting because I've been hearing some negotiations as to a soft release of a nationalized EV vehicle from one of their internal manufacturers, and it would only be offered internally. And so, if that would be the case, they would offer battery cells and other forms of technological advancements that are, I would assume, far superior than Tesla. I slightly diverge there, but I think that Tesla has a lot of competitiveness coming in, especially if we're looking at the legacy automakers coming in and just translating their manufacturing lines into EV lines. And that's a fairly easy task. Whether we look at the redundancies of GM or Ford, they're always going to have fiscal stimulus towards the government. If we're just looking at GM and Ford's pension plan, on aggregate, they're roughly worth, let me give you the actual numbers and I'll be able to tell you that. Sorry, give me 1 second. So GM right now is, let me give you, sorry, I'm right there. GM is worth right now roughly $185 billion, and this is give or take. And then when we go forward, this is $72 billion. And when we look at the actual assets held on hand, they're all the pension structures across the United States, like the $6.7 trillion pension structure that we have, has a standardization of assets. And so when we think about too big to fail and who's going to be divvied to like the more supporting of like these EV bills, for GM will definitely be more underlying to these stimulus. Sorry for that sophistication there.
All right, thanks, David. Hey, Chris.
Oh, hello. I was invited to speak, I think.
Oh, Toast dragged you up. Where did Bed Bath close today? Ooh, I guess the Gamma ramp fell off a cliff.
Yeah, it fizzled out. I've been watching these bond prices every day. They just keep going down. Um, I think they settled at like 5 to 6 cents on the dollar across all maturities. Um, so it's not looking good for the debt, and the equity is still at around 400 million or so. So
Yeah, I see the
doesn't
last trade price on the 24 Bed Bath bonds at FINRA showing 7 cents, and yeah, like you said, the 34 and 44s were at a nickel.
yeah, and I guess the equity doesn't really feel that yet.
Exactly, the equity is still living in meme land.
Yeah. So, and the borrow fee is like around 140%. It's been dropping actually a little bit. It was at 400% for a few days when there was that, squeeze going on last week, and then like early this week people were really hyped. But yeah, with those options expiring today, the January 2023 options, people were hyping those up, and now they're all worthless. So,
A call writer's dream.
you know,
I cannot disclose the size or scale, but I would note that Wook did opt to write what we felt were attractively priced Bed Bath calls Tuesday morning during the price and vol spike, and as we had, I think, suspected, things were a lot less exciting than the folks buying those calls thought they would be.
yeah, that's understandable. I haven't really been. I had a couple of calls in Bed Bath that I exercised, but but I closed that position. It was just a speculative trade, just a small amount.
Do you see, because I saw yesterday the notification come out from the exchange that they've got to get the 10Q out. I hadn't seen if the 10Q had come out yet. It sounds like I saw another headline today, I think it was, that they are hiring even more folks for a bankruptcy filing. Obviously, no one knows unless they're SUGov exactly where they're at in that process, but do you have any insight?
There was an article that said there was, in addition to Sycamore, there was another company that wanted to acquire Bed Bath assets. Um, I don't know if they'll be competing with Sycamore, right? It's just a rumor, but yeah, I
Yeah.
think it seems like from what the rumors have been coming out, and like the thing with the media is like they've people like to hate on the media, but like they've been kind of accurate with Bed Bath. They were right about the loan.
Apes like to hate on the media.
Yeah. So like in August, there was that Philo loan that was rumored that was
Right.
true. There was a private bond deal in November, right? On Bloomberg Law, there was that article I shared, and that ended up being true, right? And like with this bankruptcy stuff, like I mean, if Barron's is reporting it in the Wall Street Journal, like these are like not like Benzinga or like Yahoo Finance. Like these are like pretty respectable publications, and like I don't know, they're wrong sometimes, but I mean about Bed Bath, they really don't really have much at stake. You know what I mean? So
Yeah, I'm looking at the CNBC article from today, and it just talks about the slew of different advisors they've hired uh, over the last weeks. The
they hired
line
that
is that the
David
company's been running
Gaskin
a
guy.
sale process in hopes of finding a buyer, as well as looking for financing that would keep it alive. I mean, they're basically looking for debtor in possession financing. It sounds like in
It looks like it.
some sort of a structured agreement, I guess, where they can get some capital, figure out a deal. But it does seem like
Oh,
Chapter 11 is the final stage in all likelihood. Things can always
mhm.
change, but I mean, the reporting's been pretty consistent, and like you said, it's by and large seemingly been accurate on Bed Bath as this has progressed.
Yeah, I mean, I think management is really to blame here. They have had chances to dilute, to right the ship, and they've really blown it at every turn of the track.
Yeah,
So
it's like you said, the equity today, oops, not BBY, that's Best Buy, BBBY. The equity today is just shy of 400 million market cap. I mean, that equity value is, likelihood going to be zero or close to it should there be a Chapter 11 filing. But the fact that as we've talked about, they have an at the market offering. But I think the issue was, and I know you and I were not 100% sure, and if there were a bankruptcy expert who were listening and wanted to chime in, without providing any advice and share their perspective, we'd value it. But the thinking I had
mhm,
understood was that because they are kind of in these bankruptcy negotiations, they have information that they would likely need to disclose, and they could probably only do that to like a private placement qualified party as opposed to through the at the market, like maybe something like AMC had done with
yeah,
Moodrick. But obviously they didn't, or they haven't yet. I'm with you. It seems like trying to sell equity to someone, because clearly there's a buyer and there's an appetite right now at this moment in time, and that it looks like they missed the boat.
yeah. I mean, I don't know how much cash they have left. Um, I don't even know if they have 24 million to make that coupon payment on February 1st. So it's um, they haven't stated what they're gonna do, of course. But yeah, I have this position in the unsecured debt, and I don't really have my hopes up, especially with unsecured debt and bankruptcy. You can't really expect to get a whole lot.
Yeah, and I don't think a
Um,
buyer is. And I know that there's been folks. I think the hopefulness has gotten to some of the speculators on the long side, but hopeful that there would be a buyer that would identify the buybuy BABY assets as as worthwhile. But then it gets back to you're not going to get top dollar bidders in a distressed situation like this, and
they're gonna wait for a bankruptcy and then make a bid,
right.
right? It's like these bonds have a change of control provision, so that makes a buyout before bankruptcy just unfeasible.
Yep.
So it's that whole situation with Bed Bath. It kind of stinks. I know you had this thing with Playboy. This is probably worse, given the horrible management they've done with their capital allocation.
Yeah, I mean, this is a prime example of just really them being over their skis. Like Mark Triton clearly deserves the bulk of the blame with the failed transformation. And granted, there were difficulties that the company faced, like COVID, that I think we mentioned it like last week when we were talking about it, that when certain retailers were forced to be closed and then your Targets and Walmarts of the world were able to remain open, consumer spending patterns likely shifted spend from something like a Bed Bath toward these other in-store retail venues and also, of course, other e-commerce venues. And the strategic kind of going to the owned brands, which didn't work, and then them trying to go back to national brands. But by that point, they didn't really have the capital left because they've done so much in buybacks. I know it was over since like 2004. It was over $10 billion in buybacks
Oh
that
yeah,
they had conducted. And so it's like it's a
and I think
crazy
that
figure. In the last several years,
yeah,
it's hundreds of millions. Which if they had that money back today, we wouldn't be having this sort of conversation.
yeah, and I think this unsecured debt was issued for buybacks back in 2014. So I think that's what I read,
Mm,
that
that
these
sounds right.
all these bonds. Yeah. So I mean, and that's right when
Yeah,
their
the
cash
the
flow
24 at least was
started
offered in
struggling.
in 2014, so I'm guessing they all were, and that sounds right.
They all were, yeah. But yeah, it's a complete like failure of capital allocation. They and they also just failed to adapt. You go to a Bed Bath store, and even over the last few years, like their buyers they're just not as good as, like, for example, like a TJ Maxx, right, where they're able to just get things at good prices that people want and just get that turnover, right? But like Bed Bath, they just it seems like they're asleep or something. They're buying the same stuff and they're not really adapting um, to consumer tastes. Not really in touch. So there's so many problems with the company. It's not just like one person. Mark Tritton, you could blame him. But um, yeah, it's been a pretty bad situation with Bed Bath, and it's such a quick fall. Just 1 year. The bonds were at par just a year or so ago, and then now they're at like a few cents. Crazy.
Yeah, that is it's been a rough ride for bondholders in Bed Bath. It's about the
Most upsetting is when you look at Vanguard's ETFs and other ETFs or even mutual funds, right? Bath and Beyond has played a huge role. Not huge role, but it's been an allocation. And when we consider like risk management through these funds, like there's been a standardizations of holding, I would say, less than adequate assets within these funds. Especially if we look at the Canadian pension plan and the investments inside, let's say, crypto, that has been completely negligent.
You mean YOLOing into Bitcoin isn't prudent for pension funds?
I mean, you're enlightening me at this point.
I I saw a tweet this afternoon in that vein. The city of Miami mayor Suarez making some asinine comment because he's been, I guess, for like 2 years now getting his paychecks in Bitcoin, and he made some asinine comment that he was up, and it's like, yeah, maybe the dollars equivalent in your account is up because you keep getting paid, but there's no way you're up in terms of cost basis, given how many payments you received, 50, $60,000 level, buddy. But grifter's gonna grift.
What's more interesting is using Bed Bath and Beyond as an illustrative type study, because when we look at businesses and let's say faulty risk management and credit acquisition, especially in the last say 5 to 10 years. The biggest individuals, obviously, if you think we're in a healthy situation, go long financials, or a healthy economy, go long financials. But it's going to be indicative that there's going to be a layer of tranches or new credit tranches that Morgan Stanley, Bank of America, and other formal banks are going to create in order to divvy all of these businesses, mid businesses, small businesses, and large businesses, credit compression. And that's already happening in negotiations within Canada, but specifically in underlying the mortgage securities. So essentially, they're going to divvy multiple tranches for the mortgage debacle that we have undergoing in Canada, and they're going to be layered within the 3 categories and more categories depending on how they want to structure it. But essentially, 50% of the majority of mortgages are backed by the government in Canada, so it's going to be interesting how they play. But the same proposition is being held within, let's say, credit and credit compression within these businesses.
Jeff, good discussion. Chris, sorry, go ahead.
Oh yeah, I think that's a really good point. You know, in the last like 10 years, we've had a really easy credit environment where a lot of these loans, they have very few covenants and they don't have as many rights. But like with this, you know, current bear market, you know, all of a sudden these creditors, that, um, to underwrite new debt will have a lot more rights and they'll be able to, you know, have, a lot better terms when it comes to these things.
Oh, and there are banks right now with better capital and healthier capital ratios and debt ratios that are just waiting for this opportunity. I mean, picking up debt on Bed Bath and Beyond, or insured debt that on 10 cents on the dollar is a profitable claim, and then once it's underwritten and or let's just say certified by a certain government entity, then you're fine. And so this is happening a lot. Like we see the Jamie Dimons and the essentially the larger banks have better capital ratios just waiting for this opportunity. And it is that. It's like vultures waiting for the credit compression and debt compression.
I saw Howard Marks in an interview on Bloomberg. I think it was yesterday. It was earlier this week, but somebody asked him, about the opportunities, and he's like, "Well, I hope we're going to get some." And of course, they're distressed investors, and yeah, no one knows where things will head. But it does look like there will be. There's already been some retail bankruptcies. Party City um, is the one that comes to mind on the retail side most recently, and it seems like there will be plenty more of these if the underlying economy doesn't decide to surprise to the upside. Um, but I've been saying it. I think that credit is more attractive than equity, at least if you're talking about domestic. I know Chris. I don't know if you saw sharing in the bonds channel in GMEDD, kind of emerging market credit. And John Authors, I always kind of tout his newsletter. I think he does a fantastic job. Was talking about emerging market debt. Pulling up on the screen, he has a bunch of different visuals that he shared in his newsletter from Thursday. It came out Wednesday night, early Thursday morning. Just kind of showing that EM sovereign high yield debt looks compelling relative to U.S. high yield. And I know I'm not an expert in the space, so I haven't really touched it yet, but that's kind of in line also with what we've said about ex-U.S. equities relative to U.S. equities looking more attractive.
What's your risk premium in EMs or emerging markets?
The spread for EM high yield versus US high yield looks like about or a little under 400 basis points. This is November 30th data. It's a little aged, so it might be a little different.
One thing I always say to a lot of like anybody that I'm going to be giving any forms of research is emerging markets don't have the political security that the United States has, and it's very much easy to think about like when solvency issues do arise, or let's say we have another Brazilian type situation where there could be some formal ideas where you might not have the same facility of redemptions over your assets and or the liquidity that you might need, especially for thinking sovereign debt and or bonds, right? And so outside of, let's say, Eurozone and even the United States, Eurozone is slightly speculative because, again, when we look at solvency issues, the ECB has a lot of limited abilities and essentially are forced to instigate a price stability and artificial rate between, let's say, the German Bunds and the Italian bonds by virtue of, let's say, price stability and outside of fundamental differences of GDPs within countries, right? And so this is becoming a fairly interesting proposition because there is an arbitrage that could be made, and in the sense of like if I'm appropriating a European fixed income type allocation. But when we're looking at, let's say, any other forms of EMs, and even Turkey, right? Turkey has a lot of history in sometimes having solvency issues, and so one a larger topic at hand here is specifically investing inside China as well. I think that this is a very smart ploy that Chinese political systems and economic systems are developing, considering their communist regime. And in that hypothetical, and it's been stated by their own like parties in 2016 that one, we're going to subsidize tourism in outside of China in order to inflate economies within, let's say, bordering countries, Japan, South Korea, and even the United States. And so certain higher affluent Chinese tourists get subsidized roughly 200,000 USD per week just to come in and purchase goods and services. And then there's even an idea that we're going to increase, and this was stated by the actual government of China, essentially to encourage individuals to build indices and manufacturers like Tesla. And from there, the potentialities of our own nation being built up off of a capital external from our own area is much better. And so hypothetically, they're structuring their economy that if, and this is a big if, China decided to say, I'm cutting off all economical trades. I'm deciding to reduce any formal solvency towards your American stock participators, now having more than 43% of U.S. holdings inside Chinese subsidiaries owned through the Caymans or British Virgin Islands, and there's no actual legal reclaims so that even or get that liquidity. So I'm going to finalize it here. EMs have a lot of like of understandings and risk spreading that needs to be maintained there.
Yeah, there's always going to be a lot more risk when you're going outside the US, and certainly not recommending any particular actions for anyone, more an observation that, at least on a relative basis, EMs look more attractive than the US for high yield, and equities, EM equities look more attractive. They bounced hard. I think we noted that they bounced.
Do you think one reason why they might be more attractive right now is because a lot of these currencies already dumped like last year?
So if we look at the stock participations and or retail participations worldwide, right? 70% of all global market participation is within U.S. markets. And if you look at European, let's say, stock participation, there it's fairly negligible. Only 20% of the population to roughly 25% actually have stock holdings, and this is your higher echelon population. Now you go into China and you go into Japan. Japan has an actual, like a deep, like how can I say, gambling philosophy around owning stocks and not being a participator of the company that you're hired in. And so when you're looking at global participation, specifically in pension funds, in slowing and slumpish economic times like we are in now, most investors, due to the search for yield and the lowering of spreading risks, will go into the United States. And this is institutional players like pension funds and insurance funds. And this is just by virtue of the needs of redemptions and liquidity of their clients. Let's say if you're an insurance fund, you're always going to have a claim in associations to your mortality rate, right? And so you're going to divvy your mortality rates between 5 years to 50 years, and you're going to hold your fixed incomes in appropriation to that.
And we saw how that went for the UK.
Well, actually, that's a perfect example, and this illustrates the standardizations of all global assets. The reason you see the 10-year bond in the United States Treasury follow suit to the 10-year gilt is because of this spread of risk. If we're looking at actual currency swaps that are held across both of these countries, they're holding each other very much by a standardized asset classing. And in fact, the UK pension structure is heavily invested within the United States. So if we look at the UK University of Submarination, roughly $111 billion. We have the Royal Bank of Scotland, we have the BT Group, we have the Lloyd's Banking Group, and Electricity Supply Pension. These are the largest, aggregating to roughly $400 billion worth of funds, and essentially the largest holding a 28% weighing within the actual UK pension structure. But this is very important because the majority of their assets are held within the United States, and this is why I stated prior, 70% of their participation is within U.S. markets, and this is all their funds.
What's interesting is from Bank of America's Global Fund Manager Survey, at least in January to date, there's been a huge outflow from the US with a big shift into Eurozone, EM, and out of US equities and to a lesser extent UK equities. So, it's just very interesting because you have global macro kind of, I guess the consensus is still that the global economy is going to have a very low growth year. Some markets worldwide are going to be entering recession in 23 or some point in the near future. Seems to be again be the consensus. And it's surprising to see, I guess, EM run so hard with that backdrop. But on the other hand, when you zoom out really far, you can see that the level of US overvaluation relative to the rest of the world was getting to pretty extraordinary levels. So maybe some of that is what you were kind of implying, if there's forced buying going on of the US because of different rules and mandates. The nice thing for individual investors is you don't have a mandate. As Buffett always says, you don't have to swing at any pitch that you don't like. And if the equities in the US look very pricey to you, of course, you don't have to buy the index. You can always scour individual securities and you can always hold cash, which is easier said than done. And it's easier to, I think, sell than it is to buy back in sometimes when that happens. On the other end of the spectrum, I can't think of the financial advisor's name, but she was talking about a woman who had in 2008 gone all to cash after seeing some losses, and literally for 15 years has been all cash. So that's not at all what I'm saying. That's unfortunately something that happens though with just human nature. If you're a very risk averse person, not understanding that a diversified portfolio, you will have some downs, but your ups over an investment duration should be more than your downs. But yeah, good discussion. It's 5:26. Again, if there's anyone in the audience who wanted to come up and chime in, share their thoughts, certainly welcome you to. We've had a good discussion on Tesla, on electric cars, on PLBY, on Meatless meat, a few other things. If anyone wants to chime in, please feel free. Otherwise, I think we'll probably wrap in the next 15 minutes. I got JM coming up. Good afternoon, sir.
Good afternoon. I had a quick question about Tesla superchargers. If you guys have been following, have you been seeing any, I guess, dates regarding I think they're up to, correct me if I'm wrong, V3 rollouts for the superchargers? The reason I ask is because I have a couple of luxury developer clients down here that I've been working with to try to get superchargers onto their properties and assets. But as of late, I was told that they're rolling out a new version of the superchargers, and there's probably going to be a forthcoming one probably by the end of next year. So I was just curious if you guys had heard any news about that infrastructure as it pertains to superchargers.
Some, but unless anyone else wants to chime in, I don't have any recent news, JM, that I've seen. I know I'd seen the prototype V3 superchargers in 2019 when I was on site in Fremont, uh, or Hawthorne, excuse me. Um, but in terms of like where that stands now and for developers, I don't know. I don't have any unique insight. Sorry.
All good. Yeah, if you guys hear anyone talking about it, feel free to have them send me a DM. Again, I got a contact on the product side over at Tesla, but um, there's been very little traction just because I guess it seems like they're rolling out the V3s, and I imagine they're probably going to roll out the V4 soon after. So I don't want to make a recommendation on a product that's going to change. So that's why,
Yeah,
I
you're right.
noticed the
That
topic.
right. Why put in the old gen tech if you could wait a little longer and get the newest thing?
Exactly.
No,
Yeah.
I
So I
mean it's
noticed David was here, so I came and I figured I'd ask.
yeah, David or anyone else in the panel. I don't know if there's anything to share. I mean, you mentioned there might be a Gen 4. I hadn't heard about that. I do know at least on like the heavy truck side, which is not what you're asking about. They are making progress on like the megawatt charging, not Tesla in particular, but Charin, the industry group. So like there's ongoing development in that space. I just specific to Tesla don't have an answer for you. Hopefully someone else, if they do, can
Yeah,
chime in.
I heard the Gen 4 is mostly to accommodate the Cybertruck and other vehicles that they have in the pipeline. So that's why I'm like, hey, does it make sense to put in my effort for the V3 or just wait a little longer and
Yeah,
just wait
like
for
I
that
don't.
V4 to be available?
Right, I'm seeing a few stories like with what you're referring to. You know, I don't want to poo-poo Elon too much. I mean, the V3's been talked about now for about what half a decade, and I, I don't know how many deployments of the V3 there are. So, with this V4, I guess the reporting started in 2022. So, with that being said, Elon talking about Cybertruck being built by the end of this year. Who knows if that gets delayed again? You're probably looking out a few years before you get to this V4 concept. But they say set to release this year, whatever that means.
Well, if Elon has the AI um, programming listening, Elon, please send me a DM, Twitter support. Let me know about this V4. I would appreciate it. It's your buddy JM from Florida.
I'm gonna make Elon mad and play a Boston Robotics video in the
Yeah,
background.
it's, it plays. Yeah, it plays something. The AI will definitely let them know. Hey, your name was being mentioned. So I say if everybody says Elon probably 10 times, maybe we might come up. We might make the list of conversations that mentioned Elon, and he might take a listen regarding Tesla Superchargers V4.
There you go. But I mean, just not specific to that topic, but generally speaking, I mean that is a big. I think that's a big step will be to lowering the barrier to entry for people is getting really high speed supercharging. Where you can in nearly a comparable speed to that of liquid refuel, plug in and get comparable mileage and carry on with your day. Once we get there, that's big. I know that's a constraint
Yeah,
for some.
yeah. No, the issue down here is just the grid. That then it's like FPNL. I don't know where you're at, but if you know Florida, they're very particular and sometimes stingy as to areas that they're looking to provide the necessary capacities to make those superchargers efficient. Like you have to put in an application, you got to pay, and the waiting list to just even get an inspection from consideration is huge. You know what I mean? So that's why I want to make sure, because there are requirements that those units have. I'm sure the V4s are probably going to have a higher capacity of requirement from a power consumption standpoint.
Yeah,
So it's like it makes no sense that you're putting in an application for a V3 and then you get your hands on a V4, but you don't have the necessary capacity in order to put it in place.
yeah,
You know what I mean?
yeah. I mean, obviously, that's one where every site is always different, and I, I don't know, how much permitting lead time do you need, and how much power do you need, and all those questions. And that's where experts come into play. And you'd be surprised. I know in our experience, again at Ryder, we didn't really put V3s in or level threes in on our shops because it was like the cost is just exorbitant, and with the equipment that we were deploying at that stage, and this was a few years back, it was really just some rental vans and that we're trying to find for rental and lease customers. So like that, a level two charger, overnight charge could satisfy that. But a lot of these applications are going to need some of that really fast charge, and if you're going to manage uptime, and yeah, if they're going to offer that as an amenity for folks in a residential building where they can plug in for 10, 15 minutes and get hundreds of miles of range, like once that's regular and all over the place, I think we'll see a lot more EVs.
Agreed. We'll definitely appreciate the time in your space, and yeah, keep up the great work and the conversation.
Thanks, Jam. Jimmy, hey there.
Rod, happy Friday. Good afternoon.
Happy Friday, sir.
Yeah, thanks for
You
hosting us.
subscribed?
I did subscribe today. Almost ran out of time because
Me too.
I thought the original deadline was like the 12th or something through TD Ameritrade, and then when the rights got amended, didn't get a notice. But
yeah, when I spoke to TDA last Friday, they were like, "Sorry, buddy, you're too late." And I'm like, "Well, I guess you guys just haven't gotten the amendment yet." And I spoke to them this morning and did it.
So, I guess a couple things. I reshorted Tesla in the 130s, which was nice. I think that's going to go down to 60 at some point. Kind of trying to stick it out for the duration of this bear market. When I called,
how low do you think it goes?
I mean, the pre-COVID level is 60, and if you're more fundamentally inclined and you compare them to any other automaker, even you take like a Porsche multiple, it's way, way, way down below.
Well, if I use
it might be a Cisco thing. I think it's a great company. I like Elon. I like Twitter, but I think the great gamma run of 2020 and 2021 in this stock is over, and we're on the other side of that. So, I've incrementally.
I'm looking at a graphic, and I'm sharing it for anyone who's following along, of EPS estimates for Tesla for 23, 24, 25, and like the stock price, they fell off a cliff over the last month or so. So like 2025, for example, they were at 870 through to the beginning of December, and they're all the way down to 740 now per share EPS full year 25. The decline for 24 is like low, 715-ish. Now it's down to 594. For 2023, it's 576-ish in the beginning of December. Now it's down to 445. So like big cuts to out year estimates, and even then, is that enough?
I guess what surprised me, the liquidity cycle aside, is
and sorry, Jimmy, before you chime in, like one other thing on Tesla just in that vein is you see the folks, the bulls on Twitter talk about, well, it's never been cheaper on a forward PE basis or whatever their assertion might be, but that's, and as you noted, that's just ignoring the reality that they still are chiefly an automaker, and their multiple is nowhere near their peers. And if we use that 445, that's the 2023 estimate now, they're trading at 133. A forward PE for a discretionary premium priced automaker heading into a higher rate environment, clearly a struggling demand environment, paying 30x plus PE certainly doesn't smell like value to me. But sorry for cutting you off.
No, that's right. Not here to talk too much Tesla, but again, when you look at even just the bull thesis, they're going to invent something new, they're going to change something. It's that kind of Apple step function type of thesis. I just don't think it holds up well. I mean, I'm not even sure that the people are focused on EPS, but I think for people that follow the company, they know that North America is not profitable. They make all their profits in China, and they can't expatriate the capital there. And so, like, just some of the parts, there's some things to be concerned about.
You mean they can't use the restricted Chinese cash for buybacks, like certain analysts have called for?
It's good for some guanxi, and that does matter. So it's they're playing a long game. But I like the product. My 4-year-old got in the back of the Model 3, did the ludicrous mode, and now she compares my used Mazda to that. It's not as fun. But yeah, anyway, just a few comments on Playboy. You've mentioned that you're paring down your position. You've got some puts to hedge your position. I'm curious, did you think about trying to get puts in XRT instead, or not directly in Playboy with the eyeball premium you're paying?
I thought 80 IV was cheap, to be honest, for Playboy. So I was happy to pay that.
And obviously, the stock is done what the stock is done, but I wonder now that I don't know that the bottom is in. Clearly, there's a lot of macro factors in 23 that we all have to go through, but just looking at the price action of the last couple of weeks, looking at volume having picked up in this year, now that management's buying in, the PE vultures are getting in, even if you're calculating like a B2C yield, it's hard to, I guess, what's the real bear thesis on putting incremental capital in at this point, in the 2s and in the 3s?
Oh, the bear thesis is that you have the same management team. There's no change. There's no governance capacity to effectuate change. And why would I trust Ben Cohen with another dime of capital? That's kind of a very simple way I'm looking at it. He's failed on every initiative that they've brought to bear. The centerfold initiative that they keep pouring capital into is dead. Unfortunately, while I still think a liquidation value is in excess of the current enterprise value, I don't think shareholders can realize that unless this subscription rights offering is.
You don't think shareholders will realize value in excess of, let's say, today's closing price?
Right. My point being that if somebody bought it and liquidated everything today, I think shareholders would get back more than the closing price. But the only way for that to happen is for a deep-pocketed player to take it private. And unless Suhail Rizvi opts to take it private, because given his investor rights agreement, he could basically, he runs the board, right? It's him, it's Ben, and then it's 3 quote-unquote independent directors who none of whom have extensive public equity experience on boards. I think that's the biggest learning for me personally is if you have such an ugly governance situation, you have an ugly management situation, you can't really make any action for activism. That's just the too hard pile, especially when it's an unproven management team, as they were. And what they have proven is that they're not very good operators. At least in my opinion. So, look, I hope that people that are still long it do see better days ahead. I just can't in good conscience commit capital to incremental capital to that situation.
Understood. I think what I'm going to try to present is not necessarily a counterpoint, but from what the machine is looking at. Let's say I'm not long, I'm not short. Fundamentally, the stock really puked after third quarter earnings, and then it bounced right back. We've been oversold for a while, and now just the last 2 weeks, we've had some really good, high beta factor exposure rallies. So clearly, it's way overbought, but on strengthening volume. The math to me, at least in the near term future, is we're back in this $3 to $4 a share mark. And I don't know, because everything you said was also relevant last week when it was 260, right? But now it's 360. So clearly, at these low priced price points and the low liquidity, things are going to move. There's a lot of brownie emotion, but I'm looking at the state of general retail being still very difficult. And I got to think if I'm creating a portfolio, I still have to. I probably have a long bias on Playboy, and I'm going to short, a basket of other retail names. I just think the upside downside you mentioned, let's say Ben Cohen is not adding value to the company. If I have an intrinsic value north of 370 for the company, and I think Bed Bath and Beyond, I think Best Buy, there's a bunch of legacy companies that could be zeros. They're still in the XRT. I mean, I think the XRT has another 30-40% downside potentially before it's all said and done. So to me, I think just paying that high eyeball to hedge here in the pits is not the best use of my capital. But at the same time, I agree with you. I'm not all in on Playboy here, even if, let's say, hindsight 3 years from now, it turns out that the twos was the bottom.
Yeah, the issue really is there's a lot more pain to come from a performance perspective. I mentioned earlier in the remarks, I follow it like a hawk. I have for the almost 2 years I've owned the stock, painfully so. And they're going to have a huge uptick in inventory this quarter. I'm really worried about just how much cash they sank into inventory. And the sales are just not holding up. Like when you're launching all these new product lines, and then I look and I see that your sales are literally, you can, again, it's publicly available. If you're a customer, buy something from them, you get an order number. It's sequentially numbered. Most Shopify users have sequential order numbering. And of course, that's what we did with GME when we put out our research in January of 2021. I was compiling all that for GME at the time that kind of showed, well, if their e-commerce results are looking like this, it clearly doesn't strike me that they're dying or dead. But I digress. In Playboy's case, it's such a low contributor anyway that when your primary growth vectors, I guess, of your owned.com and your honeyburdette.com, the Honey Burdette in the fourth quarter was down in the mid-teens from an order perspective. So you might make some of that up in larger basket size, but on net, you paid 12x EBITDA for that business, and it's now not growing. It's going to inflect to declining now. I don't know what that business will be worth today. I also know that they've poached a lot of the design team members from Honey Burdette to work at Playboy, and I also know that Honey Burdette founder left and had not so nice things to say about Ben. I have heard from investors who've spoken with her. So it's just at some point I felt the need to cut bait. And when I saw them doing this incessant pumping of what I viewed as, you have these PRs that you release. You could have announced the China joint venture at any point in the last 6 years. Why did you wait until the week after you amended the rights agreement that was not going well? Why did you pay a private equity guy $1.25 million commitment fee to backstop this failing rights offering? Everything that Ben Cohn does is shady, as I see it, and the underlying operating results are not going in the right direction, and he refuses to cut bait on the Centerfold initiative. So, and there's just no way to effectuate a change. As I said, you would need a 2/3 vote, which Rizvi plus Cohn plus Fortress plus Lance's shares is too high of a hurdle. You can't do it. And you know what? That's on me for not having had the foresight to know that it was already a bet on an uncertain management team. And when they started showing that they were unable to deliver, it should have cut bait a lot earlier. Regretfully, it didn't. But maybe I sold the bottom, and it'll rally to Valhalla now. We'll see. I have certainly seen an uptick in retail chatter on StockTwits and other and Twitter. People like to draw lines on pages. I've never been a fan of that. I think it's a waste of time and energy, but people like to do it. And certainly looks like some people think that the lines on the page mean that the next step is up. But I won't be along for that ride with you.
I'll say this, I think looking at today's price, because I'm still a fundamental sucker, and I do think that there is some intrinsic value in the business. So if the company is trading at a meaningful discount to that,
yeah, there is, but how do you realize it?
Which I think is north
That's
of
the problem.
which I think is north of $1 billion. You're right. That is the challenge and the opportunity. But I don't think that some of Ben's communications around the China JV are inconsistent. Even as of the third quarter conference call, he still said that was in the works. So the fact that we got that press release, the timing is curious in between the rights offering, but that's valued at $250 million, and Playboy. So you have a minority.
The partners
Yeah, you have a
valued it at
Chinese.
$250 million, right?
But they've committed capital, right? They've committed some form of capital, and they Playboy as a majority share owner in this joint venture if it's valued at 250. Clearly, there's private equity or there's private capital interest that values the fee stream, which I think they collected about 14 a quarter. Maybe there's more to that. I don't know if that's completely replacing the fee stream, but you got to think at some point the China licensing and the broader opportunity set, they're paying some type of forward revenue multiple or earnings multiple on that fee stream for that JV. But like that imputes almost nothing for the rest of the business. So for me, it goes back to like, what are the unknown unknowns? And clearly we could have a much deeper recession. I think on a core basis, I still think Playboy might be positive year over year in 23. I think, again, they've right-sized Lovers, they've right-sized Yandy. A lot of that's going to zero. But from an EBITDA contribution, there was not much there. From a gross margin contribution, there was not much there. I love their foray into adult goods. That's non-perishable. It's very, very high margin. They were selling a lot of that already at Lovers. So being able to upsell that in the Playboy channel, I think is additive. Ultimately, I do think what we have is a company that's a little bit slimmer, that focuses on higher margin products that are a little bit more defensible. Again, their gross margin is still going to be pretty strong. And you have a company that's coming out of its cash flow burn phase, whether it's new store openings. If you think Honey Birdette is really as bad as you think it is, then they're not going to open any stores in 23. But clearly the incremental return on their capital in the US is still pretty decently strong. So like I said, I'm willing to go along for the ride here. I think there's a very, very compelling longer term opportunity, particularly if the factor exposures.
Yeah, look, if Ben Cohn gets eliminated from the question, I would be back in. I mean,
it's probably double, right?
I mean,
if he gets hit by a bus,
again, that's where it gets back to. I
$6
can't just hold on to it in that hope because there's no path to do that. And that was my failure from an analyst perspective early on to identify that.
I think when the company has over $1, almost 150 a share in cash, probably less now with the dilution, the rights offering.
No, it's not going to be that high. No, I don't think it'll be that high. But because it's going to go from like 46 million shares out to 65 or so, right?
So it's still $1 a share in cash, with debt, of course. But again, I've got I'm quite bearish on the overall market. So I've layered in shorts here and there, but over a 12 to 24 month duration, if we can get out of this 23 period, 24 period, I think this is one of my more asymmetrical opportunities. Famous last words.
Yep. For the sake of the folks who are still in it and who will remain in it, I hope that they make money. I would like nothing more than Ben Cohn to lose all his money, but unfortunately, those two are not outcomes that are that can go together. We'll see what happens. I'm more interested to see when they shutter Centerfold. I mean, that has been dead in the water, and unfortunately, I think it's one of those where he refuses to shut it because the moment he does, he has to fall on the sword. So it's a lot of perverse incentives, and
it's underway because originally, if you notice, what they did was they try to get you to download not even their app, right? They wanted to save money from the app store. They want you to put a shortcut to your homepage. But now when you do that, even the Playboy.com, it's not optimized for mobile. Clearly, there's another transition underway. But I do think it looks marginally better. We've talked about this before. It's not new news, but you don't have these blurry photos that just kill engagement.
Yeah, I've spoken to an entrepreneur who's built businesses in that space, and in addition to the conversations with him and just my own observations of it, I just don't think they have the right people in-house to do what they are trying to do. Clearly, they tried to do too much, and perhaps with hindsight, the move was simply licensing their name to a Fansly or Patreon or OnlyFans itself. But we can't change what happened. I know that Amaranth's agency explicitly tells creators not to do business with Playboy because of how poor the experience she had with Cohn and Co. was. So there's a lot of hair now on it that wasn't there. in 2021 because of management's foibles, if you will. But
I do think fundamentally that they misread the opportunity set for basically adult entertainment in the 21st century. I think a lot of the legacy, we've talked about how things have gotten more hardcore, things have gotten much more towards this kind of creator, simp type of model, and there's a demand for other things. And they wanted to thread that needle between Instagram and OnlyFans, and they failed pretty spectacularly at that. I think Instagram and Twitter are more hardcore than Centerfold, so I'm not sure who that target demographic is. But again, if they're collecting a 20% market share or a revenue cut, structurally the business model can be profitable, but they have to get that target demographic right and the offering right.
Yeah, and look, if there's execution, I'm looking at analyst consensus. Granted, we're literally talking about one analyst, so it's not really a consensus. Is one person's EBITDA estimate for 25 at least.
Has Lance coached the numbers down yet?
So for 23, the EBITDA, this is 4 analysts have 23. They have a 22 million EBITDA for 23. So I think the EV calc is probably skewed. I don't think it's picking up the 50 million in preferreds, which again, I've yet to hear any analyst ask the question, how did you go from feeling that you could raise 50 million in preferred capital issuance in May and coupled with a buyback announcement that you then didn't act on at all, and then saw the business deteriorate so meaningfully that in just 3 months then you had to take massive goodwill impairments and asset impairments. To me, haven't pursued a books and records request. I do think it would be in shareholders' interest for a shareholder to pursue that and understand what the communications between the board and management were during those periods. But, that's not something I'm interested in investing any more time and energy into.
In hindsight, that was not a bad capital raise. 8% in this capital environment. They're trading at 1 times revenue.
It's not that in hindsight it was a good raise. It's that they outright lied about it. They lied to my CIO.
Well, they
Ben lied to John Space at lunch, and that you can't invest it with a liar. That's kind of what it boils down to.
And I like that philosophy, but what does their current short-term credit look like?
So they have covenant waivers through 24, assuming they can make these debt paydowns. That's why they're going for this rights offering to pay down their secured term loan and basically get them these EBITDA waivers in their credit covenants.
My last point is this, because I heard a bunch of people say before that they were going to have to sell Honey Birdette. I mean, doesn't this basically give them the bridge to keep Honey Birdette? I mean, I don't think any creditor wants to operate that business and thinks they can do a better job than an existing operator.
I would be surprised to see them own Honey Birdette by the end of 23.
Then would you be surprised to say that we're not going to invest any incremental capex to new stores and that our free cash flow is going to be very, very positive next year?
I don't think that they're going to have meaningful free cash flow contribution. No.
If they open 0 stores,
where's the growth coming from? I mean, they just have such an obscenely high operating cost. I mean, Ben's paying himself $800,000 a year salary, cash salary, plus we haven't talked about the non-cash dilution, which is just atrocious and ongoing for both himself, the board, and others. So it's just not a very shareholder-friendly structure that I see. I don't know. It's just there's so many lower hurdles, and I just again can't invest with liars.
Missed $300 million this year, right? The analyst estimate is at 294 from their original 350 guidance. They dropped their guidance. Even if they do 250 million next year, which would be a meaningful decline, which I think they can beat it. I don't know what the estimate is.
303 full year sales next year.
So
this year, excuse me, for 23. We're in 23.
What's for 23?
303.
Okay, so it's still flat to marginally up, but let's say it's down 15-20%. Even at 250, if they're hitting north of getting close to 50% gross margin, that's 125 gross margin. You back out all the EBITDA and the G&A.
Gross margin is not
You
going to be
assume,
that high. I mean, looking at how
you
much
don't think it's going to
inventory
be
they're going
50%?
to have to be discounting and how much I think they discounted in the fourth quarter, yeah. I mean, I know that they did an adjusted gross margin because of an inventory in the last quarter, and these guys are renowned for making their financials difficult to understand. I'm just saying that the EBITDA estimate on the four analysts covering 23 is 22 million, with the low at 5 and the high at 44. And I'm not sure offhand what the conversion.
That assumes all the digital, that assumes all the incremental capex, though, right? There's some adjustment.
I don't know how many stores people are baking into their models.
That's all I'm saying. I'm saying like at today's price, if people want to be bearish and say that they're not going to keep Honey Birdette, then they should do the work and back out all the spend that's not going to happen into these platforms.
Yeah, I mean, look, with Honey Birdette too, you could argue that, and they paid over $300 million, around $300 million for it, and a chunk of that was equity issued at net 43 a share. So even if they get $100 million for it, in the context of where the equity trades today, it's still a win, I guess you could argue. But look, I've spoken to several different people about what they think the Honey Birdette valuation would be. There's the optimists, which clearly this is a conversation with an investor who had a conversation with Ben, thinking they can get over 200 million for it, maybe even 3, which is asinine to me at least. I think that 100 to 150 is much more likely, assuming that the EBITDA generation is around 30 million still, because it's just not growing anymore. And that,
well, I think it's not growing because we're in a bad macro environment. I think the brand itself still has a lot of runway over time. They just came out from Australia, where they're a category leader. You mentioned the cost of equity consideration to the price. I think ultimately it's worth more in Playboy's hands than anyone else's. So I don't know that it's in their interest to try to find.
I'll just tell you, speaking with multiple investors who had conversations with Ben, the tone from everyone was that they're getting ready to sell it. Was that they are basically getting to a situation where they don't have a gun to their head, so they can sell it without the gun to their head. Granted, that may change, and it could change, but conversations with management over the last week or two, a couple of investors who had those conversations relayed to me that was the tone they received from management. So I can't tell you anything more than that. Again, I hope to never be as hyper upset in the weeds on a stock that doesn't deserve to be. I was going to say,
who are the investors who are left? They're in this room. We're the only investors that.
Yeah. Another point. I don't know if you noticed that on the latest filing, Builders Union pulled out of the rights offering. They were not there in the listed parties that had committed to the rights. So maybe that's why they had to drag Michael Soroya in, because BU stepped out. But look, it's as always a very fun discussion with PLBY. I hope that we don't cover it next week in next week's Wook in Review, and there isn't news. Unfortunately, there was a lot of news, and we felt the need to cover it. But again, just so everyone is aware that my conversation pertaining to the actions I took were on my own position, not pertinent to Wook's position or positions. So just to make sure that's clear. But look, it's 6:00 on a Friday. We've had 2 hours of good dialogue. David, thank you for joining. Jimmy, I appreciate you chiming in. I know we disagree on it, but appreciate your perspective. I think Chris might have dropped, but appreciated his thoughts on Bed Bath. And we appreciated you all joining us on this lovely Friday in January, on the short week for some of us. Just to kind of recap, just so you're aware, social programming coming up. We will be covering the Microsoft earnings next week. We'll also be covering Tesla. I'm sure there will be other conversations around Tesla on the Twitterverse, but if you'd like to join us, we will be talking about Tesla during their earnings call. We'll live stream it. I know it's a little later in the night, but same with Microsoft. We'll skip our Wednesday open mic because we're going to have a lot of content going on next week with those 2 earnings calls and with the Friday Wook and Review. We will have our book club on Tuesday the 31st at 8 o'clock. So Margin of Safety, Seth Klarman's fantastic value investing tome. Get yourself a PDF copy. Read that, scope it out, join us, 8 o'clock, Twitter Spaces, Tuesday the 31st. We'll talk about Margin of Safety. Dive into the Wook Discord if you want to share some thoughts for different books we should cover in upcoming book clubs. Again, that's a monthly book club on Tuesday. The last Tuesday of every month is our plan for the year. We'll continue to host our Wook and Review calls on Fridays at the close with our newsletter out in the morning. And we'll keep covering some different companies for earnings. And if you have any interesting ideas for different things, I do want to do some investor interviews this year. I don't have anyone lined up yet. I have a couple people in mind. There's one person in particular I'd love to interview, but we'll see if he decides to return to the realm of social media. But otherwise, thanks again, everybody, for tuning into this week's Wook and Review. I'm Rob Altman. Cheers. Have a great weekend.